Growing demand, smarter networks, and stronger commercial credit activity are reshaping the future of telecom. Welcome to the Commercial Pulse update for August 11th, 2026. The Experian Commercial Pulse is a bi-weekly report offering a snapshot of the US economy and its impact on small businesses. We hope you find these bi-weekly updates insightful. Remember to hit subscribe to continue seeing us in your feed. July unemployment declined to 4.1%, down from 4.2% in June, reaching its lowest level since June of 2025. Average hourly earnings continue to increase to $32.40 per hour in July, although the pace of wage growth has slowed. At the same time, hiring weakened. The US economy lost 23,000 jobs in July, following a revised gain of 20,000 jobs in June, marking the weakest monthly employment reading since February of 2026. Together, these figures suggest the labor market remains stable, but hiring momentum is slowing. Inflation continued to move in a favorable direction. June headline inflation eased to 3.5%, down from 4.2% in May. Consumer prices declined 0.4% month over month, marking the first monthly decrease since 2020. Lower oil prices in June helped moderate inflation, while both rent and food inflation also eased. Core inflation declined to 2.6%, suggesting broader price pressures continued to soften. Economic growth also slowed during the second quarter. According to the Bureau of Economic Analysis, annual GDP growth eased from 2.7% in the first quarter to 2.1% in the second quarter, while the advanced estimate of quarterly GDP growth slowed from 2.1% to 1.5%. Although growth moderated, the economy continues to expand. Consumer sentiment rose 11.5% in July to 55.2. Although still below last year's level, improving confidence could support spending during the second half of the year. Another encouraging signal came from the NFIB Small Business Optimism Index, which increased to 97.4 in June, reflecting stronger expectations for future business conditions and declining uncertainty. At the same time, the personal savings rate declined to 2.7%, highlighting that consumers continue to rely on spending despite ongoing inflationary pressures. The Experian Small Business Index declined by 0.7 points in June to 50.5, down from 51.2 in May. While the monthly movement reflects modest softening, the index remains 5.8 points higher than 1 year ago, indicating that overall conditions for small businesses continues to be stronger than they were this time last year. The combination of easing inflation and a relatively stable labor market has helped maintain a favorable operating environment for many small businesses, even as economic growth moderates. The index continues to reflect balanced access to commercial credit, improving business stability, and an overall environment that remains within the healthy historical range for small business performance. This week, the Pulse report focuses on an industry experiencing an interesting transformation: telecommunications. When most people think about telecom, they immediately think of wireless carriers, but the industry is much broader than that. Telecommunications includes wired carriers, wireless providers, satellite communications, cable program distribution, resellers, and a growing collection of specialized communication businesses. Together, these subsectors form the digital infrastructure that powers nearly every industry in today's economy. Collectively, the broader information sector contributes approximately 5.6% of US GDP, making it one of the country's largest economic sectors. More importantly, the sector continues to be positioned for long-term growth. As businesses and consumers consume more digital services, the demand for connectivity continues to rise. From cloud computing to AI to connected devices and enterprise services, nearly every major technology trend depends on reliable communications infrastructure. That growing demand is reshaping where telecom companies invest and how they operate. One interesting characteristic of the telecom industry is that revenue growth isn't being driven by traditional voice services anymore. Instead, growth is increasingly coming from fixed and mobile data services as businesses and consumers consume more bandwidth than ever before. According to the Ericsson Mobility Report, data traffic per smartphone has nearly doubled over the past 5 years and is expected to double again over the next 5 years. In other words, communications companies are carrying dramatically more data every year, creating opportunities for continued revenue growth, even as older voice-based services gradually decline. Today, the industry's focus has shifted from simply building 5G networks to maximizing the value of those investments through new enterprise services, automation, and premium connectivity offerings. What's particularly interesting is that this revenue growth has occurred while the industry's workforce has steadily declined. Telecom employment has fallen from roughly 1.25 million workers around the year 2000 to fewer than 600,000 today. That reflects a fundamental transformation of the industry. Years of consolidation have reduced the number of carriers, while automation, cloud-based infrastructure, software-defined networking, and artificial intelligence have significantly improved operating efficiency. Today's telecom companies require fewer employees overall, but a larger share of highly specialized technical talent. Telecom is one of the few industries experiencing declining employment alongside long-term financial growth. Those industry trends are reflected in Experian's commercial credit data. Growing revenue and ongoing investment creates a unique commercial credit profile. Although telecom companies are becoming operationally leaner, they continue investing heavily in infrastructure, technology, and network modernization. And that's exactly what we begin to see in Experian's commercial credit data. Compared to businesses in most other industries, telecom companies seek commercial credit more frequently. Experian's data shows commercial credit inquiries run approximately 12% higher than businesses outside the telecom sector. That gap has widened in recent months, reflecting continued investment. Not only are telecom businesses seeking credit more often, they're also borrowing larger amounts. Over the past several years, newly originated commercial lines and loans have averaged roughly 30% higher than those originated by businesses in other industries. That aligns with what we'd expect from an industry investing in network modernization, advanced infrastructure, AI, and the next generation communications technologies. Another interesting trend is the recent increase in new commercial originations within satellite communications. Satellite connectivity is becoming a larger share of newly originated telecom accounts as businesses expand coverage into rural markets, support for direct-to-device communications, and develop complementary network solutions alongside traditional wireless infrastructure. It's another indication that investment is shifting toward emerging telecom technologies. Historically, businesses outside telecom carried higher average balances over commercial trade. Over the past year, however, those balances have largely converged. While it's too early to call this a lasting trend, telecom credit behavior is becoming more aligned with the broader commercial market. We'll continue to monitor whether this convergence persists over future reporting periods. Perhaps the most encouraging trend appears in portfolio performance. Telecom has historically experienced more volatile delinquency patterns than many other industries. Today, that volatility has declined substantially. Over the past 4 years, 90-plus day delinquency volatility has fallen roughly 70%, while overall late-stage delinquency levels have declined approximately 40%. For lenders, that's an encouraging sign that telecom's credit performance is becoming more stable. And there's much more on the telecom industry in this week's Commercial Pulse report, so be sure to subscribe. If you would like a deep dive on some of our insights, reach out to your Experian account team. And if this update was helpful, please like and subscribe to support our channel. Last, remember to keep informed, to stay ahead, and we'll catch you on the next one.